the first time since the 2008 economic crisis, the central banks of the euro area and the United States headed in different policy directions in 2014. European Central Bank President Mario Draghi and Janet Yellen, the new chair of the Federal Reserve, were responding to the US economy improving as the eurozone's weakened. By September, the ECB had cut its benchmark interest rate to a record low of 0.05% and was talking of needing to do more to boost growth and inflation.
Should it become necessary to further address risks of too prolonged a period of low inflation, the Governing Council is unanimous in its commitment to using additional unconventional instruments within its mandate.
The ECB also launched long-term cheap loans for banks to lend on and further stimulus through the purchase of so-called asset-backed securities, that is, those with real collateral from the banks. The US, meanwhile, was relaxing stimulus.
Still, there is more to do. Too many Americans remain unemployed. Inflation remains below our longer-term objective, and the work of making the financial system more robust has not yet been completed.
In February, Yellen, who'd just taken over the top job at the Fed, was talking of winding down its massive stimulus program, though borrowing costs would remain super low. The different monetary policy approaches reflect widely differing growth rates. After a difficult bad weather-related start, the US economy was up nearly 4% in the third quarter compared with the same period in 2013. By contrast, the eurozone stagnated, while Britain's GDP expanded by 0.7%. The lack of growth and renewed risk of recession hit core Europe, the two largest economies, Germany and France. The powerhouse of the currency bloc, Germany, narrowly escaped recession in the third quarter, and its exports weakened, sanctions against Russia being a factor there. The French government failed to promote growth or bring down jobless totals. Its planned economic reforms were rejected by unions, employers and trade organisations. The sluggishness in core economies, like France and Italy, was noted in the peripheral ones, where some believe they're both being held back by the same things.
There can't be any progress or improvement in the investment climate as long as there's such a high level of taxation in Europe. We in Greece have austerity, and even some of the core eurozone countries have no specific plans to move forward from the crisis. So in the end, Draghi's decisions might add up to nothing.
The threat of deflation overshadowed the eurozone all year. Indeed, near the end of the year, annual consumer price growth fell to just 0.3%. Germany and France experienced lower inflation. Italy and Portugal hovered around zero. Spain and even more so Greece saw prices tumble. The situation reminds many of Japan, where for 15 years prices slipped, persuading people to put off purchases, particularly big-ticket items, reducing consumption, investment and growth. This lack of growth, even as southern European countries move towards more flexible labour markets and experience lower wages, continues to anger ordinary people. In Italy, for example, it's led to widespread anti-government strikes and protests. In Greece, government employees and students alike say they see only a bleak future, with too high a human price being paid for their international bailout. At the same time, there was further mistrust of economic institutions, from cases of high-level corruption, such as at Portugal's family-owned Espírito Santo Bank. Facing bleak prospects and having run out of other options, the European Central Bank's now considering doing what the Federal Reserve stopped doing in October: quantitative easing, printing money to buy government bonds of eurozone member states.